guys, we got this great clip from one of our long content videos. Don't forget to hit the subscribe button. Enjoy. What's the difference between assuming a mortgage that exists versus just buying that same property subject to the mortgage that already exists? And both can be great ways to acquire properties to keep as rentals, or to buy and fix and sell, or just to buy and live in, right? So here are some pros to assuming an existing mortgage when you're buying a piece of real estate. You're gonna take over the mortgage from the current borrower. So the owner of the house right now, he went and he got one of these historically low interest rate loans. He's got a 30-year fixed loan. He's found himself wanting to sell the house, and you convince him that you're gonna come in and take over that loan for him, relieve him of his obligation to pay the loan back. You're gonna be fully qualified with the bank, and you're gonna completely relieve him of his obligations. You effectively become the new borrower. You assume all of the risk, and the last borrower is out, and he has no more risk. So it's very attractive for the seller to allow you to assume the mortgage. It can be really, really beneficial, especially right now, because interest rates just 6, 8, 10 months ago were historically low. We talked about that earlier. Because of that, if you can then assume that person's mortgage, you might save 2, 3, 4 percentage points on your mortgage, as opposed to if you bought the same house and went and got your own mortgage. So you come and you qualify for an FHA mortgage and you do a new purchase. There's costs that are associated with that new mortgage. There's a higher interest rate today, absolutely, for sure. Like a good interest rate today might be 6%. A good interest rate 10 months ago might be under 3%. So you can see how valuable buying a house and assuming this mortgage could be. But you're going to save money on closing costs. You're going to be able to make these transactions in theory quicker, right? So if the bank allows you to assume the mortgage and you qualify and you do all of these things, it can be quicker. It certainly will be cheaper. So these are the pros. In the con, you have to qualify with the bank. So you have to have good credit. You have to have enough money to pay for the thing. You have to be able to show tax returns. And a lot of times real estate investors have a hard time showing those tax returns. Even though you may make more money than most people you know, you also don't show a ton of money, and a lot of your money can be written down, and so you don't have to pay a lot of taxes on it, so your tax returns don't look like you make a lot of money, but you live a very good lifestyle because of cash flow and depreciation and things like this. You get great tax benefits and you get to write off your income, so it makes it harder to qualify for a loan. And if you're assuming someone's loan, you're going to need to be full qualified. So that's a con. The biggest con, and I think this is the one that will get most people, is that the banks just simply will say no. Doesn't matter if you're the most qualified buyer in the world, the bank would rather sell you a new mortgage and lend you money at today's rates, especially today, where, 10 months ago, again, they might have been sub 3. Now today, a good interest rate might be 5.5%, 6% would be a really good interest rate. So the bank obviously would like to be paid off on that mortgage where they're lent at 3% and then re-lend the money to you at 6%. That's just common sense. So those are some pros and cons about assuming the mortgage that exists today. Now let's get into the same house and buying the house subject to the mortgage that already exists. First, let me define what that means. Instead of assuming the mortgage and coming in and qualifying and talking to the bank and jumping through all of the hoops, you simply say, listen, Mr. Seller, I'm going to step into your shoes. Your name, you're still going to be on the hook for it, but I'm going to put my money where my mouth is, and I'm going to start making the payments month after month after month. And you're not going to tell the bank anything. You're going to just buy the house subject to the existing mortgage. So when you buy a house with a mortgage that you're buying subject to, you purchase the property like it says, subject to the existing mortgage. The original borrower, he remains responsible for that mortgage, and so he's requiring and he's relying on you as the person who's stepping in and buying the house subject to make the payments on his behalf. And if you don't do that, you're going to screw up his credit. You're going to cause him to have a foreclosure on his name. He's got some liability. So just keep that in mind. And when you're doing this stuff, you need to do it with integrity and do what you say you're going to do and pay these bills. The pros of buying it subject to, it's really, really fast, right? Like, so you can come in, you can find a motivated seller who's got a mortgage that he took out 10 months ago, and now he's 3 months behind, and he's in pre-foreclosure. He hasn't paid the bank in 3 months. He's on his way to a foreclosure sale. He's going to lose the house because he lost his job or he got a divorce or his wife died. Who knows why, but he's got some motivation. He's behind on his payments, and you come in and you say, listen, I'm going to bring your loan current and I'm going to take over the mortgage subject to. I'm not going to relieve you of your responsibility, but I'm going to put my money where my mouth is, and I'm going to buy that property. And by doing that, it's an easy transaction. It's a quick transaction. Hey guys, thanks for watching that. Subscribe to our channel, watch this next, and then also check out the pinned content for more great content, guys. God bless.